There's a rhythm to the market, a kind of psychological pulse that only a trader who observes without bias can truly sense. Most traders never do. They jump in at any moment, buy or sell because a candle looks a certain way, and then wonder why the market seems hostile toward them. But if you've been following my work, you understand something deeper. The market is neutral, always neutral, and your job is to read its behavior, not impose meaning on it. In the previous video on the entry trick to boost win rate, we explored how timing and alignment with market behavior can tilt the probabilities ever so slightly in your favor. Today, we're going to talk about when the market expresses its clearest structure. The best time of day to trade for maximum psychological and probabilistic clarity. Now, don't misunderstand this. The market doesn't distribute opportunity on a schedule. It doesn't open at 9:30 and say, "Here's your gift for showing up." No, the market is simply a mirror. It reflects the collective beliefs and expectations of every participant. It wakes up as new information is processed, as emotions surge and then settle, and as order flow reveals the intentions of those who truly influence price. That first hour, that's when you can feel the raw emotion of the herd. Ever noticed how the open feels like chaos compressed into a short burst? Overnight expectations, reactive orders, anxious traders who simply can't wait, all of them collide in the first 60 minutes. It's fast, loud, erratic, and loaded with psychological traps. So I ask you, do you charge into that uncertainty, acting on impulse? Or do you wait until the collective emotion stabilizes and the market's behavior becomes more readable? I learned early in my development that the first move of the day is often misleading. The inexperienced push price aggressively in one direction, while the professionals, the traders who understand the probabilistic nature of the game, quietly position themselves on the other side. If you want to trade like a genuine professional, you don't react emotionally to the movement. You interpret it. Watch how the market behaves after the initial burst. Is the conviction real? Is volume supporting the motive? Are the leading instruments moving with structural intent? Or are they hesitant and inconsistent? When you train your mind to observe without projecting fear or hope, you'll catch the moments when the market transitions from randomness to clarity. Not when everyone else is excited, but when the market's behavior aligns with a stable, probabilistic edge. Now I can almost hear the question forming, are you saying the opening hour isn't worth trading? Not at all. The open can provide exceptional opportunity if your method, your emotional makeup, and your risk beliefs are aligned with that type of volatility. The scalper thrives during the open because rapid movement fits his belief system and his strategy. The position trader, meanwhile, may wait for the quieter mid-morning structure when false moves fade and authentic behavior emerges. So ask yourself, what kind of trader are you truly? Because you cannot act against your own beliefs about risk and expect consistent results. You see, trading isn't about prediction. It's about aligning yourself with what the market is actually showing you. Confirmation through behavior, not expectation. The best time to trade isn't static. It's when your setup, the market's behavior, and your internal state align. That alignment, more often than not, develops shortly after the open, when the emotional noise begins to thin. Around 10 o'clock, the market reveals its first real card. By then, you can often distinguish who's trapped and who is in control. That's when the professional acts. That's when patience overtakes excitement, and probabilities quietly shift toward those willing to wait. But here's the challenge. Most traders can't wait. They crave action. They crave stimulation. They want to impose their will on the market instead of interpreting what the market is offering. Ever felt that urge yourself? The voice saying, "Act now, you'll miss out." That voice is the dividing line between the gambler and the trader operating with a probabilistic mindset. A trader earns his profits not by frequency, but by quality, by taking trades when his edge is present, and the market's behavior confirms it. The clock doesn't control him. His discipline, his beliefs, and his patience do. The middle of the day is a different environment. Between 11 and 2, the market becomes quieter. The professionals withdraw. Volume fades. The crowd grows impatient, and boredom lures traders into low-probability trades. Trades motivated by discomfort rather than opportunity. Don't fall for that psychological trap. I've seen more traders damage their accounts during those sleepy hours than during any morning spike. If the morning is emotional turbulence, midday is emotional drift. And if you don't understand that shift, you'll confuse stagnation with potential. Remember what we discussed in the video on the entry trick to boost win rate. A good entry is not just price, it is timing and context. You can identify the perfect setup, but if you take it during a dead period, it's like planting seeds in frozen soil. The lack of energy suffocates your edge. Timing creates the difference between a trade that moves smoothly and one that leaves you doubting your strategy. By the afternoon, the rhythm shifts again. Around 2 a.m., institutional money begins preparing for the close. Momentum returns. Volume picks up. The charts regain life. The final hour reveals whether earlier moves were genuine or deceptive. But many traders repeat the same mistake they make at the open. They chase movement because it feels urgent. They forget that the market doesn't reward urgency. It rewards clarity. If you miss the opportunity, don't chase it. The market will open again tomorrow, offering new patterns, new behavior, and new probability structures. Trading is a waiting game that masquerades as an action game. The best time to trade isn't when the clock tells you to. It's when the market's behavior aligns with your plan. The open, midday, and close each have their own psychological texture. Your responsibility is to understand which one resonates with your method and your beliefs. Some traders earn their entire living in the first 30 minutes. Others remain silent until the afternoon, striking only once when the probabilities align in their favor. The difference isn't luck, it's understanding. And that understanding begins with deep, unbiased observation. Spend a few days watching the market without trading. Just watch. Observe its behavior at 9:30, at 10:30, at noon, and at 3. Feel the shifts in emotion, energy, and conviction. The market communicates through behavior, not words. Can you read it? Because once you can, you'll stop forcing trades and start recognizing genuine opportunity. It's not flashy. Patience rarely is. But every truly consistent trader I've met learned that real timing isn't about a clock. It's about the ability to wait for the moment when the probabilities quietly lean in your favor. When you internalize that, you no longer need to trade all day. One solid trade, taken at the right moment, outweighs a dozen impulsive ones. Remember that the next time your screen lights up and your emotions tell you to jump in, the market isn't a machine. It's a constantly shifting reflection of human belief and expectation. Most traders don't notice this. They treat the market as static, as if the environment at 9:30 is identical to the environment at 3:30. But if you observe behavior long enough, you recognize the truth. The market breathes. It expands, contracts, hesitates, and accelerates. It expresses different moods throughout the day. And if you want to survive, let alone thrive, you must learn to move with that rhythm instead of resisting it. I used to think the market was mostly about price levels, support, resistance, trend lines. But those are only pieces of the puzzle. Time of day reveals the underlying emotional structure, the expectations behind the moves. It tells you who's active, what beliefs are driving the flow, and how committed traders are to a move. The open, the midday lull, and the close each have their own emotional signature. Think of them as separate scenes in the same performance. The tone changes, the actors change, the emotional energy shifts. You wouldn't speak with the same intensity in every scene of a play. So why trade with the same assumptions all day? Look at the opening bell. That's the emotional surge, the release of pent-up beliefs accumulated overnight. Amateurs rush in, first reacting to headlines and gaps, acting out of fear or excitement. Professionals wait. They observe how the market absorbs that energy or rejects it. The open is a psychological test, not a directional promise. The first lesson in understanding market behavior is recognizing that morning emotion doesn't automatically reveal truth. Sometimes it's genuine conviction. Sometimes it's emotional noise. Your job is to recognize the difference. Then as the clock moves past 10 o'clock, the tempo shifts. The emotional burst fades. If you observe closely, you'll see the market settle into its truer behavior, the kind that isn't driven by fear of missing out. False moves dissolve. Authentic structure takes shape. This is where the professional finds his edge. He's been waiting for the emotional wave to subside, for clarity to return. You might call it patience. I call it alignment with probabilistic truth. The trader who understands timing understands that the market has a heartbeat, and he waits for the rhythm that matches his beliefs, his edge, and his discipline. Ever notice how between 11 and 1 everything seems to slow down? That's not your imagination. That's the shift in collective trader psychology, the market's neutral, low-energy phase. The participants who truly move price are paused, recalibrating their decisions. News flow slows, volume thins, and the market transitions into a state dominated not by intention, but by indecision. Prices drift not because they're stable, but because there is no meaningful participation behind the movement. If you don't understand that this is simply the market's quiet hour, you'll misinterpret stillness as structure. You'll take trades that don't have the support of committed participants only to find yourself exposed when the afternoon volume returns. This is the danger of confusing time with opportunity. You start trading the clock instead of the actual market conditions. By the time the afternoon session begins, a new psychological tone returns to the market. The professionals resume activity, algorithmic flow increases, and the process of positioning for the close begins. This is where you begin to observe whether the morning narrative remains intact or whether the collective psychology is shifting into a reversal. If the market has been strong but volume fades, it's a sign of exhaustion. If it's been weak but suddenly attracts renewed buying near the close, you may be witnessing the early footprints of institutional positioning. You can feel it in the tape, the subtle urgency, the confident but quiet pressure, the sense that something is being prepared beneath the surface. Now think about what this means for your trading. If the market cycles through moods and you ignore those shifts, you are trading blind. You're walking into different emotional environments without adjusting your expectations. Would you dress the same way on a storm and for sunshine? Of course not. Yet most traders trade the same way in every hour of the day. There's a time to act and a time to observe, a time for precision and a time for patience. The trader who internalizes this rhythm doesn't merely react, he flows with the market's behavior. Let me tell you something I learned through experience. When I was young, I thought trading every minute the market was open meant I was dedicated. But all it showed was my discomfort with stillness, my impatience. The truth is, there are only a handful of moments in a day when the probabilities meaningfully align in your favor. These moments aren't hidden. They express themselves in the rhythm of the market. The market tells you when it's active, when it's resting, and when it's gearing up again. The trader who pays attention can align with that rhythm. The one who doesn't will always arrive just a step too early or too late. You might be wondering, how do I actually sense that rhythm? Observation. Unbiased, patient observation. Sit and watch the market without trading. See how it behaves at different hours. Notice how volume expands and contracts, how spreads widen or tighten, how leadership stocks dominate at one time and completely shift at another. This is the form of self-education most traders skip. They want systems, not awareness. But real awareness, true understanding, makes a trader sensitive to the market's psychological landscape. Every professional understands that a price pattern without context is meaningless, and time provides that context. A breakout at 10 o'clock means something very different from a breakout at 2:30. You must ask yourself, who is active at this hour? If the emotional morning crowd is driving the move, maybe you fade it. If institutional money is positioning into the close, maybe you align with it. The tape looks different at different hours because the traders behind the movement are different. Midday trading, the quiet stretch between 11 and 2, has misled more traders than the most violent open. It looks calm, even inviting, but it's deceptive. You see the candles flatten, volume shrink, price barely moving, and something inside whispers, now is safe, now is calm. But stillness is not safety. It's a vacuum. The midday period is when the market's major players step aside, when the large orders pause. What remains are traders who cannot tolerate waiting, those acting out of restlessness rather than opportunity. Ever found yourself clicking buy or sell simply because you felt you needed to do something? That's the midday illusion at work. The market, like any living system, cycles through energy and rest. After the morning's emotional surge, where beliefs clash and direction emerges, the market needs to regroup. By late morning, the participants who matter have already acted or are waiting for additional confirmation. What remains is a low volume, a landscape filled with false comfort. Prices drift sideways not because the market is balanced, but because it is waiting for new information, waiting for fresh conviction. When the tape slows, traders lose patience. That's where the trouble begins. They start forcing trades in what I call boredom zones. A setup that looked weak in the morning suddenly looks appealing simply because the trader wants movement. But the market doesn't reward emotional discomfort. It punishes it. Every seasoned operator knows that during these hours, liquidity thins, spreads widen, and stops get hit by meaningless noise. You think you're catching a breakout, but it's not a breakout. It's just random fluctuation. I've seen countless traders fall for this trap. They think, if the morning was too volatile, maybe the midday calm is easier. Maybe I can catch something simple here. But there are no simple moves. A market without energy is a market without clarity. You can't ride a wave that doesn't exist. The rhythm that drives profitable movement, the conviction, the participation, is missing during these hours. So when you find yourself staring at the chart around lunchtime, ask yourself, is the market offering me something, or am I attempting to force something out of it? There's a reason professionals often step away during this stretch. They understand that silence isn't opportunity, it's preparation. They use these hours to review morning trades, assess structure, anticipate the afternoon, and, most importantly, avoid unnecessary damage. That mindset is the defining difference. The novice wants to do something. The professional waits for something worth doing. One chases the market, the other aligns with it. Now you might argue, but moves sometimes start during midday. Shouldn't I be prepared? Of course. Preparation is essential. But preparation is not the same as restlessness. The key is to distinguish between genuine beginnings and noise. True midday moves are rare, and when they do begin, they unfold quietly. Accumulation, gradual tightening, controlled volume. They form the foundation of a larger move, not a sudden jolt. You'll see subtle commitment in the tape, not erratic ticks. But you'll only recognize these nuances if you're not buried in dozens of low-probability trades at the same time. Do you remember what I said in that earlier video on the entry trick to boost win rate? Timing matters more than prediction. The same principle applies here. Entering during the midday lull is like planting in dry soil. Even if your analysis is right, the market may simply lack the energy to move in your favor. It sits still, draining your patience, until a sudden afternoon burst hits your stop long before the real move unfolds. When traders complain that their setups have stopped working, often it isn't the setup, it's the timing. They're executing valid ideas in dead fake zones. You must understand the psychology behind the midday trap. The human mind craves rhythm and resolution. After the intensity of the morning session, that sudden quiet feels unnatural. Your internal energy drops, the adrenaline fades, and your brain begins searching for stimulation to fill the void. That's precisely when false signals begin to look convincing. A small uptick suddenly feels like a breakout. A tiny dip looks like a reversal. The screen seems to whisper, "Do something." But you must remind yourself, no signal means no trade. In a probabilistic game, absence of confirmation is itself information. The best traders understand that restraint is not weakness, it's capital preservation. And if you sit through enough sessions with genuine awareness, you'll begin to sense the pattern. Around 11, the morning energy evaporates. The chart compresses, volume shrinks, and price drifts in tight ranges. That's the market communicating clearly. Wait, by around 1:30, you'll feel the market slowly waking up again. Volume starts ticking higher, directional movement becomes visible, and the tape regains breath. This is when the preparation you did during the lull pays off. While others were burning emotional and financial capital on low-quality trades, you conserved yours for the hours that matter. I remember a trader years ago who couldn't handle silence. Every day he'd complain, "There's nothing moving." But instead of waiting, he'd begin shorting or buying random names, convinced there was hidden opportunity somewhere. By the close, he'd be drained, emotionally spent, and down for the day. I told him, "You're trying to force profit out of stillness. The market doesn't pay for effort. It pays for timing." He didn't like hearing it, but he learned, eventually. Midday trading teaches patience better than any other time of day. This is when your discipline is tested strongest. Anyone can trade when the market is loud. Few can sit calmly when it's whispering. If you learn to respect these hours, not fear them, not chase them, but understand them, your entire approach improves. You take fewer bad trades. You preserve mental energy for the right setups. Your edge sharpens. The midday lull isn't your enemy. It's your teacher. It tells you to slow down, to wait for genuine information, to plan instead of react. It separates the impulsive trader from the probabilistic trader. Every trader who lasts long enough learns this lesson eventually. The market gives clues every day, and one of the clearest is this. When it gets quiet, it isn't inviting you to act. It's asking you to listen. The last hour of the trading day is the stage where real participants reveal themselves. All day long, the market has been sending signals, testing sentiment, shaking out impatience. But as the clock moves toward the close, something shifts. Volume builds, volatility rises, and the market's character transforms. You can feel it in the tape. That midday hesitation dissolves, replaced with clear intention. This is when the participants who truly move price, institutions, funds, large traders, step forward. They position for tomorrow, adjust exposure, square accounts, and often set traps for those who aren't paying attention. If you've observed closely throughout the day, the final hour can reveal everything about the market's authentic direction. This isn't about predicting, it's about confirming. When a stock has shown strength all morning and continues attracting volume late in the day, that's conviction. When a rally collapses in the last hour, that's exhaustion. The close reveals who's in control. Are buyers confident enough to hold risk overnight? Or are they offloading into strength? Are sellers pressing advantage or covering to avoid overnight uncertainty? The tape tells the story, if you can interpret it. You might wonder, why does this hour matter so much? Because the close isn't just another time. It's the market's signature for the day. Closing prices influence valuations, fund reporting, margin calculations. Professionals know this. That's why they act decisively. Amateurs, meanwhile, react to what they see rather than understanding the significance behind it. They chase short bursts of movement, hoping to squeeze a final win, while professionals think a day ahead, shaping the next session's tone. I've always said, the market's mood in the last hour reflects its true strength. A strong market closes strong. A weak one limps into the bell. The final prints show whether earlier moves were meaningful or merely noise. Many of my best trades came not from trading the close itself, but from studying it. Because when you understand the close, the morning rush and the midday drift suddenly make sense. The entire day finds context. Do you remember in that earlier video on the entry trick to boost win rate how we discussed waiting for confirmation rather than trying to anticipate it? The same principle applies here. The last hour is confirmation time. It's where patterns clarify or break down, where breakouts either hold or fail. The trader who waits for the close to validate structure avoids many of the traps that snare early entries. You don't have to trade the close, but you absolutely must read it. It tells you whether the setup you've monitored all day is worth carrying into tomorrow. The close is also a mirror of trader psychology. Think about it. Every decision made during the day converges here. The anxious day trader wants to flatten. The swing trader must decide whether to carry overnight. The fund manager must align the portfolio with end-of-day valuations. All these intentions collide into one concentrated hour. It's not random. It's the highest concentration of purpose in the daily cycle, and purpose creates opportunity, if you can read between the lines. Around 3:30, you'll often see something special. Volume surges. Dormant stocks suddenly awaken. Sometimes it's genuine continuation. Sometimes it's a trap designed to mislead. But if you're patient and perceptive, the tone gives it away. In a strong market, the surge feels natural. Pullbacks get absorbed, breakouts follow through. In a weak market, late rallies get sold aggressively. The behavior of this hour has nothing to do with luck. It's about pressure, real pressure. The market is showing you where the informed money wants to be positioned when the session ends. Many traders avoid the last hour, thinking it's too chaotic or risky. And it can be, if you're unprepared. But it's also where the cleanest moves occur, because most of the noise has already burned off. The fake breakouts of the morning are gone. The midday drift has exhausted the impatient. What remains are traders acting with intention. When a stock pushes into the close with strong volume, that isn't random, it's confirmation. It signals that buyers are willing to hold exposure. That kind of conviction can spill into the next session. But don't confuse conviction with urgency. High volume doesn't automatically mean you should chase. If you didn't plan the trade earlier, it may be wiser to study the close instead of jumping in. The close gives you tomorrow's blueprint. It reveals sector strength, institutional interest, and the setups worth tracking. When the market shuts down for the day, that's when preparation begins, not when hope starts. The rhythm of the market begins fast, slows down, then accelerates into the close. It's like the tide rising, receding, then returning with force. The professional trader doesn't fight this rhythm. He uses it. The last hour is when the tide comes back. If you've spent the day observing properly, this is when you understand whether the current aligns with you or against you. Every candle, every tick, every volume spike tells a story. I've known traders who built entire careers around this hour alone. They'd wait all morning, study midday, and execute with precision in the final 60 minutes, because that's when inefficiency becomes obvious. By then, the market has revealed its true intentions. The false moves are gone. The direction, up or down, has weight behind it. But this approach requires discipline. You must resist trading simply because movement appears. The key is not to respond to noise, but to read the intention inside the noise. Once you learn to study the last hour, you'll start noticing patterns others miss. You'll see quiet accumulation during the lull. You'll detect distribution disguised as late-day strength. You'll see where the market wants to go before the next session begins. The close is the market's diary. It records the truth of everything that came before. To an untrained trader, it looks chaotic. To an experienced observer, it's revelation. Patience in timing entries is one of the hardest skills in trading because it contradicts human nature. Every trader wants to act, to participate, to move with the flashing screen. But the market doesn't reward participation. It rewards precision. The difference between the consistently profitable trader and the losing trader is rarely intelligence or knowledge. It's patience. Waiting for the right moment instead of acting just to feel involved, that's where consistency begins. You can study every pattern, memorize every setup, master every indicator. But if you lack the patience to wait for genuine alignment, all that knowledge becomes irrelevant. The market has a rhythm, a tempo, and your entries must synchronize with it. When you force a trade, you step out of rhythm. The best entries feel smooth, almost effortless, because they appear when price, time, and sentiment align naturally. No hesitation, no emotional pressure, just clarity. Most traders never experience this because they confuse movement with opportunity. But movement without structure is randomness. Patience allows you to distinguish between the two. When I first began trading, I wanted activity every hour. I believed more trades meant more chances to win. But what I eventually learned, painfully, is that more trades simply mean more risk. The market always offers something to chase. It takes discipline to recognize that most of those offerings are traps. Think about your own experience. How many times have you entered just a little too early, only to watch price move against you before the setup fully formed? You weren't wrong about direction, you were wrong about timing. The idea was correct, the patience wasn't. Trading isn't about prediction, it's about alignment. You align yourself with the market's rhythm, and that alignment often takes time to appear. If your setup requires volume confirmation, let volume appear. If you're waiting for a breakout, let the market prove it. The impatient trader jumps at the first sign of movement. The patient trader waits for confirmation and captures the meaningful part of the trend. One trades potential, the other trades probability. And probability is what pays. Ever notice how the best trades move in your favor almost immediately? That's not luck, that's timing. When you enter too early, you spend half the trade hoping. When you enter too late, you're chasing. But when you wait for true alignment, the market does the heavy lifting for you. That moment of clarity appears only when you let the noise settle. You can't see through turbulence. You must let the air clear. Patience also protects your mental capital. Every unnecessary trade drains emotional energy. You may not notice it at first, but it accumulates. Frustration from small losses, fatigue from constant monitoring, tension from uncertainty. Eventually, judgment weakens. Then mistakes compound. Confidence erodes. But when you train yourself to wait, to skip the noisy hours, to pass on weak setups, you conserve energy. You stay sharp for the trades that matter. The market punishes impatience quietly. It doesn't always take your money immediately. Sometimes it takes your focus, your clarity, your belief in your system. You start tweaking your strategy, chasing new signals, abandoning your edge simply because you can't tolerate silence. That's when you drift off the path. The patient trader, on the other hand, embraces the silence. He observes. He listens. He lets the market reveal its hand before committing. And when it's time to act, he acts decisively. Not because he guesses, but because he has seen enough to